John Taft, September was a rough month for stocks. The S&P was down 7%, but we've seen a nice bounce back so far in October. So is the worst over?
Yes and no. This was the long-awaited correction a lot of individual investors have been worried about. It was a correction, down 12% in late August, but as you point out, it snapped back pretty quickly. So by the time they got their September account statements, which did show decline in values, the market had already recovered. What you have to look for, though, is that there are losses, unrealized in many cases, in client portfolios, and any good financial advisor is going to sit down and talk to their client about taking losses, harvesting losses to offset gains. That's going to happen over the next 30 to 60 days, so it could suppress the market for a while, but that'll be temporary. I think this was the correction we've been waiting for.
And speaking of suppress, we've seen the 10-year Treasury yield stuck around 2% for a long time now. Is that reflective of the U.S. economy?
The U.S. economy has been on a steady, albeit somewhat anemic, recovery since the financial crisis. And a lot has been written about it, how it's much slower and less robust than previous economic recoveries. And I think, though, the bonds, and this is, we're not alone in this opinion, are overvalued. The economy is stronger than the bond market is giving it credit. And that creates the conditions for a potential backup in yields sharper than people realize when and if the Fed starts to tighten.
All right, let's stay in bond land. So you like corporates, but you like them in the middle of the curve. Talk about what you're looking for in corporate bonds right now.
Well, corporate bonds and municipal bonds are beneficiaries, if you have cash to invest, of a widening in spreads. So the highest quality bonds versus lower quality bonds, you get paid more to take credit risk today than you did several months ago. That presents an opportunity. We're not counseling our clients to drop down below investment grade. Quality is always an important consideration, but if you are willing to drop down to, for example, a BBB rated security versus a AAA rated security, we think you're getting paid today to take that additional credit risk where you weren't several months ago. Then when it comes to where do you position yourself in terms of maturities, what we call the belly of the curve is the sweet spot, 6 to 8 years. What we think is likely to happen when the Fed raises short-term interest rates is that the long-term end of the bond market will see that as fighting inflation, and it could even rally. If you're in the middle, it's like being at the lever point on a fulcrum, and that's where investors get the best risk-return profile.
Speaking of spreads widening, a lot of worry right now in the high yield market, and some people say, well, spreads are widening in a high yield. This could portend for bad things, even in the stock market going forward. Are you worried about high yield?
Worried in general about investors over the last several years faced with, like you say, 2% Treasury bond yields at the long end, faced with 0% returns on cash, which means you're actually losing purchasing power, looking for yield, shopping for yield in securities that have a risk profile that's greater than they recognize. And what will happen is that if you're in high yield bonds and any more than a reasonable allocation, 5 to 10% or something like that, or really high yielding equities, when rates do back up, you're going to see significant, sharp, and painful price deterioration. So that's worrisome.
And then switching back to stocks, which sectors or stocks should you be shopping for right now? What looks good to you?
Yeah, our recommendation to investors, many of whom you have to understand are nearing in or moving through retirement, looking for income, is to look at high quality dividend yielding stocks. During this recent correction, particularly in the energy sector, there were a number of really good companies that got beaten down, meaning the yield is more attractive, and I would look around those areas right now if I were an individual investor. Dividend yielding stocks that got hit in the recent correction.
All right, well, thanks a lot, John.
Thank you, Greg. Appreciate it.
And thank you for watching The Street.